this is Ron Ruff with a market update video for January 2020. Happy New Year and Happy New Decade as we start a new decade of the 20s. Today I wanted to talk about the outlook for this year, and I thought it might be interesting to take a very high level look and look at this decade that just passed, the decade of the tens. It was interesting in a couple of respects. Number one, there was no recession that happened in this past decade, which is unusual. Secondly, there were no official bear markets in this decade, which again is very unusual. We did have several good corrections, 2011, 2015 into 16, and then also obviously the fourth quarter of 2018, where it was almost a full-fledged bear market, but not quite. So if we think about the decade though, the market finished averaging about 14% per year from 2010 through 2019. And that's actually about 40% better than the average, which if you look at the S&P returns over the very long term, you're looking at about 10%. So at 14% a year, we're about 40% above average. Now, if you look at the slide here, you'll see that going back over the number of decades, the 80s and 90s were actually even better at 18% a year. And then we had other decades, the decades starting this century, where returns were actually slightly negative for the decade. So at 14% a year, very strong returns. That would suggest to us, looking at history for this coming decade of the 20s, to expect maybe in the range of about 7% a year. All right, well, let's take a look at a little bit more recent information. So 2020 is an election year. If we look at history, what can that tell us about the prospects for the market this year? What's interesting, if you look at historically, at history, stocks tend to do very well in the pre-election year and the election year. So last year was a very good year, and that falls in line with what we see from history. So I've got a table here that shows going back to Franklin Roosevelt, first term presidents, and as they came up for re-election, the returns in the pre-election year and the election year. And you can see that the returns were very strong typically in the pre-election year, and on average returns were decent in the election year. So again, I think looking at history, we should expect a reasonable year for the year of 2020. Now, of course, in any year, we have to look at what's actually happening in the world, in the economy, in the markets. And so for this year, obviously the trade war with China is going to loom large for stock market returns for this year. The recent tension with Iran, that could loom large depending on what happens going forward. Obviously, a big issue for market observers and investors will be economic growth. We've seen GDP growth this year lower from 3% down to 2%. So all of these can actually have an impact on the returns that we actually see. Now, if we just go to the markets, as a technical firm, we spend most of our time looking at charts and patterns and use that to gauge our invested level rather than look at general economic fundamentals. You can see that we had a very sharp decline in the fourth quarter of last year. The first 3 to 4 months of the year, all we did was recoup those losses. Then we spent the next 6 months basically going nowhere, and all of the gains over the last 2 years, going back to January of 18, really just happened in the fourth quarter of last year. Now, the market is clearly in an uptrend, and our portfolios are basically fully invested across the board, all 6 strategies. The other area that has us somewhat less complacent, I would say, if you look at the Value Line Index here, the chart is not nearly as healthy. While we have had a breakout from the trading range and it's bouncing along all-time highs, the chart is not nearly as constructive as the S&P. And this represents a broader index of stocks. And so it's an index that we like to look at to really get a better gauge of how healthy the overall stock market is. And if we go overseas and look at foreign stocks, the pattern is even less encouraging. This chart shows foreign stocks peaked in January of 18, and they're not really anywhere close to their old highs. Now, for us, this is opportunity because possibly in 2020 we'll see emerging markets and foreign markets play catch up to the U.S. market. That would be good, but the pattern overall is not that constructive for us, or as constructive for us. So if we take all these things together, we're pretty optimistic on stocks as we come into this year. But as you know, we have our safety nets in place. And if we get any unexpected shocks, we stand ready to pull the trigger on any of these positions and all of the positions. And we'll certainly make sure that our number one goal is to protect the portfolios. And we take that quite seriously. So until next time, thank you for watching.